Hello students, welcome to Legacy IAS Academy. Today we are going to discuss about the recent exit of foreign portfolio investors from the Indian market and what are the implications of these steps that we can see on the Indian economy as a whole. So first of all, the context in which we are discussing today's video is in recent time the Indian economy or especially the Indian stock market is seeing a very sustained capital outflows and have unnerved the stock markets, and due to this not only the stock market is falling but also it has caused weakening of the Indian rupee vis-a-vis dollar and has caused a rising inflation across the globe including India. The reason why this flight of capital is happening is basically believed to be because of the US Federal Reserve's decision to hike the rates further, and outflows are likely to continue, putting pressure on the Indian currency more and more in the coming days. Now, what is the contribution of FPIs in India? So, this or how much FPIs have exited? So, now if you look at the extent of outflow of foreign portfolio investors, we can see that they own around 19.5% of the market capitalization of India, and they have pulled almost rupees 42,000 crore rupees in only a month of June so far. And the total pull out by FPIs from the Indian market has reached to almost rupees 2,60,000 crore, that is equivalent to $33 billion since October 2021. So before understanding about this whole issue, let us first try to understand who or what are FPIs. So foreign portfolio investment has been defined by the Foreign Exchange Management Act, also called as FEMA, which was introduced in year 2000. And it defines FPI as buying and selling of shares, convertible debentures of Indian companies and units of domestic mutual funds at any of the Indian stock exchanges. And that is how they differ from FDIs, that is foreign direct investment. FDIs actually introduce, or we can say invest money in the tangible, tangible instruments such as investing in the warehouses, investing in the industries, setting up even industries and construction and all these kind of things, while FPIs only focus on the non-tangible part, or we can say the money part of the Indian stock exchange. Not only that, it is the passive holding of securities such as foreign stake, bonds or other financial assets, none of which entails active management. That is the definition of FPI as far as the FEMA is concerned. So how does FPIs help economy? So suppose if foreign portfolio investment in any economy is increasing, that means it will cause more demand of the equity shares and the prices of share will rise up. Not only that, it will also increase the liquidity in the market. Due to this, the cost of issuing of share will come down, and thus more and more equity can be issued by the companies listed on the stock market. So what is the net effect of this? The net effect of this will be the capital availability for both buyer and seller will become cheaper, and listed firms can issue more stock, and there can be also new listing we have IPOs, more IPOs can be introduced, and thus companies will find it easier to gain capital or take capital from the market. Due to this, there will be more supply, more liquidity and more demand, and due to this, the overall we can see increase in the economic output or economic growth of the nation. So now coming to the current situation, that what is the factors that is driving the current sell-off of FPIs from the Indian market. So first reason is believed to be the tightening of monetary policy by the United States Federal Reserve as well as the other central banks all across the world, including Britain as well as the Eurozone. Due to this, what is happening, that the foreign portfolio investment, the investors, they want to take their money from the Indian market and want them to again invest in the safer haven, that is United States market. Also, this has been exacerbated by relatively high valuations in India as well as the rising bond yields in the United States of America. In recent time, the bond yield has increased by almost 5% within one single year. Not only that, even there has been appreciation of dollar vis-a-vis rupee, and there is a rising concern that due to current Russia-Ukraine war, the global supply chain have been disrupted. It can cause a possible recession in the United States. So these are the major reasons why FPIs are fleeing Indian market. So let us look at the background of this particular scenario. In year 2008, when the global economy took a hit, central banks all across the world, including United States as well as the European Union, they started slashing interest rate and announced very liberal monetary policies. The effect of this was very clear. As capital became available easier, there was a significant economic growth as well as more and more investment in the equity market all across the world. However, the surplus liquidity which has been injected in the financial system due to this liberal monetary policies also caused excess of capital, and this later on caused a inflation rise all across the countries. Due to this rise in inflation, now central banks all across the world have started to reverse on their original decision, and now they have started tightening the monetary policies and hiking interest rates. So these are the background looking at which we have to understand how the change of stance of central banks from liberal monetary policies to the tightening monetary policies can lead to inflow as well as outflow of the capital respectively, especially from the emerging market. So if you look at the situation of India also from the inflation point of view, what we can see that inflation has surged to an all 8-year high, and it has reached a figure of almost 7.79% in the month of April, and this has caused the Reserve Bank of India, which is the Central Bank of India, to rise the repo rate by 90 basis point to almost 4.90%. Now in brief, repo rate is the rate at which the RBI, the banks or commercial banks of India lends money to the Reserve Bank of India. So now what will the impact on market and rupee of this particular outflow of FPIs? First of all, as foreign portfolio investors start to withdraw money, take money out from the equity markets in Sensex, there will be a dampening sentiments in the equity market as well as the forex market that can cause devaluation of the value of many companies. Also, India's foreign exchange reserves have fallen as a direct result of this FPI's withdrawal, and it has fallen by almost $46 billion in last 9 months, and currently it stands somewhere about $596 billion. Not only that, it has caused also appreciation of dollars vis-a-vis rupee, and rupee has plunged to 7.3% to an all-time low of 78.30 to 32 against $1. The other effect of this can be understood from this particular point, that as the rupee is depreciating against the dollar, it will cause increase in the import bill, because we will have to pay or shell out more rupee to gain same amount of materials or same amount of goods which we are importing from other countries, and higher import bill can also cause further inflation. Not only that, the imports will stress this sector where India is largely dependent on import, and other important components will also get costlier. Now oil import is one kind of import, the increase in which can cause a wider ramification on the overall economy, because if oil prices increase, that means the transportation cost will increase, and that will cause a spillover to all other sectors of the economy as well. As food prices increase, you have increase in the prices of other different economic commodities as well. Not only that, the other effect of this we can see on the foreign travelers as well as the students who are studying abroad, and they will have to shell out now more rupees to buy same amount of dollars on the bank to spend in the other foreign countries. Now coming to foreign portfolio investors, how do they operate in the Indian market? So first of all, foreign portfolio investors have started a policy of risk of trade. What is risk of trade? Risk of trade is when FPIs move money from risky assets such as equities and add more of bonds and golds, which are considered as relatively safer assets. Now when this is done when the United States or the developed economies are rising their interest rate, and also if the bond yield in these developed economies are rising. So as we discussed, United States bond yield has been rising continuously. What it has caused? It has caused a rise in the interest rates by the Federal Reserve of US and other advanced economy as well, and that is why FPIs are now withdrawing money from emerging markets and are investing back in the safer markets like United States of America. And this is a very bad news for the market of emerging economies, because FPI sell-offs has led to decline in the valuation of top 500 companies of India, with some of them losing almost 50%, 15 to 20% of the value in last 9 months only. So that is overall impact we can understand that we can see due to FPI's outflow. Now coming to which countries contribute to the highest FPIs as far as the Indian market is concerned, you can see from this pie chart here, it is the United States of America that is the largest contributor of FPIs in India, followed by Mauritius at the second position, Singapore at the third position, and the Luxembourg being at the fourth position. FPIs not only invest in India, but they are also considered to be the largest non-promoter shareholders of the Indian market. if you look at the current value of holdings of FPIs, especially in value terms in companies that is listed on NSE, it stands somewhere about rupees 51.99 lakh crore as of 31st March 2022. Not only that, the FPIs also hold sizable stakes in the sectors like private banks, tech companies, as well as big caps companies like Reliance Industries, and that is why their exit cannot be restricted to a certain sector, but it will be have a spillover effect on the whole economy of India. So in last, if we have to think from the investor's point of view, what can investor do in this particular scenario? Now, obviously, due to the FPI's outflow, equity markets can witness further correction in the coming months, in coming days. However, as per experts suggested that other markets may correct in the meanwhile, and that is why the current investors should stick with their existing investment in the domestic equities. They should not rush to sell off. So that is all for this particular issue. Thank you very much.